Welcome, everyone. This is Victor Chang from SaaSceo.com. Today, it's my pleasure to interview our special guest expert, Rusty Hale, who is the founder of the SaaS Bookkeeper.com. He runs a outsourced bookkeeping service for, as you might guess, SaaS businesses. First of all, Rusty, thank you so much for joining me today. I'm so glad you're able to talk today.
Happy to be here.
So I want to dive right into it. Today, we're going to talk about bookkeeping, accounting, taxes, really sort of some of the financial management aspects of running a SaaS company. This interview is really geared towards the SaaS founder that might not have a finance background. Most of the ones I work with have not. And so what I want to talk about first really is really helping demystify the finance department. So for SaaS businesses, anywhere from brand new to maybe 30 million a year in sales. Rusty, can you explain what is the difference in job functions between a bookkeeper, an accountant, a controller, and a CFO? What do each of those titles do? If you can just define them so we can have that as a starting point, that would be awesome.
Yeah, happy to. Everyone has a little bit different definitions of these terms, but to kind of get that full stack of the accounting and finance function, I'll kind of walk you through how they're commonly used. The first in the process, or kind of that lower level part of the stack, is a bookkeeper. Traditionally, what they're doing is taking the transactions that come through your banks and your credit cards and categorizing them into buckets, and those make it to your balance sheet and P&L. And then once they do that, it goes to what often is referred to as an accountant, and they're taking those cash basis transactions and making them accrual basis. In other words, making adjustments to get the timing lined up, get the deferred revenue booked, and get everything kind of lined up to the right periods. And that closes out the month and puts this kind of bow on the historical financials. Then it goes to the FP&A, or the finance role. And they're using the historical data to then project what's going to happen in the future, cash flow forecasting, budgeting, modeling. And then it goes to the kind of that CFO level. And they're using that information to then make strategic decisions, fundraising, financing, product selection. And so it kind of one builds on the other, starting with the bookkeeping kind of all the way through the CFO.
Got it. So bookkeeper and accountant is focusing on what happened. It sounds like financial planning analysis is geared towards what could happen in the future. And then CFO is really helping make the business decisions that have a financial implication. Does that sound right?
That's it.
Okay, cool. And so you mentioned a couple of things in there. So that's a lot of roles, right? So for a SaaS company that's very small versus, a public one, there's quite a range there. I'm curious, in the companies that you work with, kind of what is the revenue range you have experience with? And at what stage do you see which roles in terms of either full-time jobs, people doing things, or maybe it's a founder sort of doing some of these themselves? Give me some sense of what the org chart looks like sort of by company size.
It does vary. Everyone starts out in the same place, which is often doing it themselves, putting that QuickBooks together for the very first time. And then there's a point where it makes sense to have someone help with that. That point varies depending on kind of how the company's been running. There's a few kind of common triggers to start moving to something a little bit more sophisticated. Typically is when you start having customers. If you start raising money, either have raised money or about to raise money. Oftentimes, you can kind of muddle through that first year, but then when tax time comes, you need someone to kind of help put it all together. Those are kind of the initial triggers to start looking for someone with a bit of more of an accounting background to come in. Some founders I talk to are pretty business savvy, and they've taken some accounting courses, and so they can get by a little bit further than the founders who are a little less educated in that area. And then there's just the matter of time. We all have a limited amount of time and money, and as a founder, you got to figure out how best to utilize those things.
Got it. And so for all those roles we talked about earlier, are those always done in every company, or do some companies, depending on their size, just skip certain steps, maybe even if that's not the best thing to do ideally?
Yeah, certainly as you start out, oftentimes that accounting function gets skipped, right from bookkeeping to then just kind of making decisions off of it. But usually you can find outsourced companies where you can hire fractionally, and they can cover that full tech stack for you, to be able to get a little bit of time from each of those different levels to be able to pull it all together. And that's kind of what my company does. There are lots of great options that you can do that'll come with a little bit of bookkeeping time, a little accounting time, and you can get a fractional CFO that can help with a little bit of FP&A and a little bit of strategy.
All right, so let's talk a little bit about accounting systems. What do you see in your work in terms of which accounting packages or vendors that are typically used for SaaS businesses, and whether that varies sort of based on company size?
Yeah, so we tend to focus on those smaller companies, because kind of that 0 to 10 million revenue range. And we predominantly see QuickBooks Online and Xero. Those are the two by far the most common packages. You see other ones. There's lots of great, free software out there. It's really not designed for SaaS companies. So we recommend one of those two. QuickBooks Online is the most common in the US. Xero is a little bit more common internationally, but both will work well. When you start getting up, that 10, 15, 20 million, that's when you want to start kind of looking at that next package up. Intact, Sage Intact, and NetSuite are the two most common for when you're ready to kind of move to the next level. But you can get by on QuickBooks and Xero for a long time using other revenue applications to plug in, like a Maxio or a ChargeBee. You can get a lot more functionality of it without having to jump really high in price point and sophistication at that next tier level.
Yeah, I see the same. I would say Xero, probably QuickBooks Online, but more often. I not realized Xero was more popular outside the US. That was sort of news to me. And I definitely see NetSuite a lot. And then secondarily, probably Sage for the bigger companies, which I don't typically deal with as often. Let's talk a little bit about setting up accounting books, whether it's general ledger codes or otherwise. What are the best practice things to either do or think about proactively when you're setting up the books? And what are the things that you should be looking out for if you've already set up the books, but perhaps not in the right way? Any thoughts on that?
Yeah, the nice thing about QuickBooks Online is it's really easy to change. So if you haven't set it up in the right way, it's never too late to go in and do some reclassifications. If you're not quite sure how to do it, it's pretty easy to Google, or you can hire an outside person to kind of come in and get the chart of accounts the way you want it. Chart of accounts is a term we use to talk about the different buckets you have on your profit and loss. And the way you set up your chart of accounts, and this is a bit of an art. A lot of accounting is science, but in SaaS companies, there are a few different options. When you first start your QuickBooks, it comes with a generic chart of accounts that isn't all that helpful for SaaS. And so one of the first mistakes I often see is just using that kind of generic chart of accounts as writing QuickBooks and really not kind of coding the chart of accounts to a system that makes sense for you. There's lots of great resources out there, what a SaaS P&L is supposed to look like. And so kind of customizing that for the SaaS business is the first thing you should kind of do. The second is within the revenue bucket. I often see in the early stage SaaS companies just kind of lump all the revenue together in one. It's really critical to break out the revenue by the type of revenue you have, whether it's recurring or non-recurring. And that will really help as you kind of analyze your P&L. And the third thing I often see is on the deferred revenue side. So when companies first start, they're really excited to get those first couple of customer contracts and they want to recognize all that in revenue right away. But oftentimes those contracts are 12-month contracts or 3-year contracts, and being able to spread that revenue over the service period rather than recognizing all at once. It's really hard not to do it because you want to see that revenue come in that first month. But as you start looking at monthly recurring revenue and your trends, you want to see that kind of spread over.
So related to that, with deferred revenue, which is a little bit unusual for other industries, right? So for those that aren't familiar with the term, it's, if I sell you a widget, I sold you the widget, you got the widget, you give me the cash, I get all the money like right then and there, right? As within SaaS, there's ongoing billing, right? You're sort of signing a contract now. The service you're providing, the software is delivered, month over month over month, maybe for a year, pretty typically. And then they might pay you up front, but you technically haven't earned the income until you've delivered the service. That's kind of like the legal sort of definition of earning the income is you've given the goods or services in exchange for that. And so practically speaking, you mentioned deferred revenue and you alluded to something earlier around accrual accounting versus cash basis accounting. Can you elaborate on what those two mean? And for a SaaS business, can you use both? Do you have to use one? Can you just sort of explain kind of that process? Because other companies have the choice. I'm just wondering if that's true also for SaaS companies.
Yeah, so the cash versus accrual question, for SaaS, one of the biggest components of the difference is how the revenue is treated. So in a cash basis accounting system, you would recognize the cash received as revenue when you received it. In an accrual basis, you would recognize the revenue, again, over that service period. So let's just say you signed up a 12-month contract today and it was a $10,000 annual subscription. In a cash basis, you would recognize $10,000 that month. But for an accrual basis, you would recognize 1/12 of that each month over the 12 months of the subscription period. For the books, there are different types of rules. So for kind of a technical accounting gap rule, you really want to spread that over the 12 months. You can keep your books on cash basis, but most investors don't really want to see it that way. And it's really kind of hard to run your business that way. So you have the option to keep it in a cash basis, but not one I recommend for SaaS. And there's really kind of two functions for accounting. There's the accounting for books, which is really to help make management decisions. And then there's accounting for taxes. And you can do different systems for each. So you can keep your books on accrual and file your taxes on a cash basis. And so strategically, you kind of look at the best method to do for each of them, but you can't keep them in two different ways.
Got it. So it sounds like accrual is the recommended one. When investors, like say you want to sell the company, raise capital, it sounds like they're expecting accrual. And
They
is
are.
that true? And does the company have to convert it or do they convert it? Like, how does that work?
Yeah. So most investors are looking for an accrual basis. They want to see that monthly recurring revenue trend over time. To convert from a cash to accrual, it takes a little bit of analysis. The earlier you get on accrual, the easier that becomes. If you get kind of far down the way where you got $1 million or $2 million in revenue, it's a bit more of a chore to kind of do the conversion, but you can do it. Essentially, you just redo the books on the accrual basis.
Got it. So if you're starting from scratch, do it at the beginning. If you're early, convert it. And then ongoing basis, keep it accrual. Is that right?
That's it.
In terms of, you mentioned the setting up the chart of accounts, that the out of the box default chart of accounts, which is really the categorization structure of the various financial elements on the financial statements, like travel expenses, web hosting expenses, things along those lines, that the default one with Xero and with QuickBooks doesn't really map super well, right, for SaaS businesses. Can you just give some examples of what are some things that they typically have as a default that you would recommend changing, or most SaaS companies change to sort of better fit their businesses?
Yeah, the main one I see is there's always a default category in QuickBooks for contractors. And gosh, what does a contractor do, right? In the SaaS world, it could be a salesperson, it could be an R&D person, it could be an internal marketing person, it could be the janitor, who knows? And so when you see just a generic bucket for contractors, you don't really know what you're spending your money on. And as you look at your P&L, especially as you start kind of looking at metrics and ratios, it's hard to know what the function was. So one of the first things that we'll typically see is starting to take those contractor buckets or just the general payroll buckets and divide it up, referred to as departments. So how much did you spend on people related to sales and marketing versus research and development versus customer success? Separating those people costs in departmental buckets is probably the biggest thing to kind of shift your chart of accounts from the kind of the generic one to a SaaS one.
Got it. Great. Super helpful. All right. I want to shift gears a little bit and talk about outsourcing various elements of the finance function. Most SaaS founders I know, even if they know finance well, they don't do all of it themselves just because there's a lot of work. If at the various roles, when does it make sense to outsource? And let's start with that question. Then I'll circle back on some other questions related to that.
Yeah. I think in that finance stack, the different roles get outsourced at different times. So the first thing that typically gets outsourced is the lower level part of that stack with the bookkeeping and monthly close work. And then as you get more cash flow and more need for higher level functions, then it starts to kind of go from there. I typically see that kind of bookkeeping monthly close really start outsourcing as soon as you start getting customers or when you start getting your spend over, let's say $100,000, $200,000 a year. It usually makes sense to start kind of getting someone to pull your P&L together in this SaaS specific way. And then when you start getting $1 million, $2 million in revenue, starting to get some traction, I see a lot more of the finance brought in with the forecasting and the CFO services. Because those resources do cost a bit more. You need a little bit more cash flow to kind of make it work.
Got it. And then remind me of your firm name and like where in that spectrum do you offer services?
Yeah. So the firm name is called the SaaS Bookkeeper. And we focus on that lower end. So that bookkeeping monthly close is where we typically see most of our help. And then on the income tax side as well, we help file income taxes.
Got it. Okay, great. And what does a client typically need to do in order to be a good client for you in terms of easy to work with so that you can help them better? And if you can also compare that to maybe a client that doesn't do things the right way, that makes their own lives miserable, can you elaborate on that on both ends of that spectrum? That'd be super helpful for us.
Yeah, it's not any different than any other service that you might use or any other, honestly, contractor or employee that you might hire. I think when companies go wrong here, it relates to more abdication than delegation, meaning they just said, hey, I don't want to think or talk about finances. You just handle it, and I don't want to input or participate. It is a bit of a team sport. So in order for the outsourced accountant to do their job well, they need information about what you're doing, what you're planning on doing, so they can bake those into the numbers. And then once they finish, giving it a review to make sure it makes sense with your understanding of the business. Those are kind of the key parts to play in the role. The client relationships that don't tend to work well is when they don't want to kind of participate or communicate in that way.
Got it. So by the way, I see the same thing in other functional areas. You can be a technical founder that does not want to deal with sales. So they hire a VP of sales and then sort of abdicate.
That's it.
And then like 2 years later, there's no one they call me. Like, why aren't sales growing? So I would say definitely my advice for all the SaaS founders listening in, the CEOs, you have to be engaged with every member of your team, including the finance department. And so I say, can you go back a little bit on what are the specific inputs that they need to tell you? Are you asking them for information, or do they need to volunteer it? Like what are the things they need to think about and then be engaged around so that our audience will have some sense of what it is you're needing from them?
Yeah, every firm has it set up a little bit different. We tend to set it up where we can self-serve a lot of information ourselves. We can log in, we can get the information we need to do the accounting. Most of the input from the founders comes from a couple of aspects. One, we see transactions that come through the banks or their credit cards, and gosh, we don't know what the heck you spent that money on. We can see it came through, but so in order to put it in the right spot, we need just a little bit more information about what the money was spent on and for why, and then we can take it from there. And so we'll have a weekly check-in process with our founders just to get that information real time. And then on the bank side, once you have the financials put together, they should really tell a story about where the business is going. We only have a limited visibility into the transactions that have already happened. And so that post-review of, does this make sense? Does this tell the story of what happened, or was there something missing? Most accounting transactions, we can see through the cash, but some things that happen that affect accounting don't have cash. And so a lot of it's just finding out what we don't know so we can make sure those are reflected too.
Got it. So let's say for like a SaaS company with maybe, let's call it 2 million in ARR. And if the answer is different for someone with 10 million in ARR, let me know that too.
Yeah.
How much time are you spending keeping the books, or is your staff keeping the books, versus how much time the founder is interacting with you or your team for a $2 million business and then say a $10 million business?
Yeah. For a $2 million business with our typical kind of bookkeeping monthly close service, typically the founder is spending, let's say maybe an hour a month kind of getting information to us in the way that we need it. And then maybe 30 minutes after the work's done to review it to make sure it all makes sense and there aren't questions. That's a typical commitment. So maybe, 1 to 2 hours a month is what we're looking for. For a $10 million company, typically it's not the founder that we're interacting with. Typically it is the fractional CFO or possibly an FP&A person, and they're providing a little bit more data for us. And so for those scenarios, the founder is typically really just doing kind of that post review to make sure it makes sense and the numbers align with their vision.
Got it. And then for the smaller companies, just out of curiosity, how much work is there in terms of the closing the entire month? What's kind of the typical high-low range on that?
Yeah, it varies a little bit more on transaction volume than revenue, meaning how many transactions do you have in a month? We certainly have some pre-revenue companies that have raised a bunch of money, and gosh, they spend a lot of money even though they don't have any revenue. And we certainly have some great revenue companies that, gosh, they only have maybe 5 customers, but they're just really big customers. And so how much activity goes through the account is more indicative of the time than the actual revenue.
Hey, Rusty, so I want to shift gears a little bit and talk about tax savings. What are some tax saving strategies that are available to SaaS companies that you would recommend they consider or take advantage of?
Yeah, that's a tough one. Tax saving strategies is a little dependent on kind of what you've already figured out. And so as we go into companies and look for tax savings, we look to see what they've already kind of have in place and figure out what's missing and get those in. For SaaS companies, the things that we see most often are related to entity structure. So whether they're set up as a C Corp, an LLC, or a C Corp, that's one of the areas that we see where the math really makes a difference on how the entity is set up to begin with.
And with that, is there a preferred one, or does it depend? And if it depends, what does it depend on?
Oh, it depends on so much. What the company's doing now, but more importantly, where they're going. It depends on what structure makes sense for them. For outside investors, the C Corp structure is really helpful because it changes the way the tax flows to the different owners. If you're a single founder and you own 100%, a different structure of an LLC usually makes more sense because you can control kind of those inputs and outputs a little bit easier. But then when you start getting to a certain income level, moving that LLC to an S Corp will help you save taxes overall because the math changes when you get to a certain distribution dollar amount. And so those are kind of the things we'll look at is what structure are you now, and then where are you headed for, and what structure will be successful today versus tomorrow.
Okay. And does it make sense to change the structure sort of midway if a company's already been established, or you leave it alone, or you make changes really maybe when you're trying to do a sale of a company or raise capital?
You want to change as you go.
Okay.
It's one of those things that you can't change every year. And so you have to be a little strategic on when you change and how you change. But if, let's just say you set up as an LLC and you realize, gosh, this isn't the right structure for me, a change is great to be able to convert to a structure that makes more sense for where you're headed.
So if you look at the chronology, is it like start off as an LLC for most small companies and then they move to an S Corp when the business is big enough, and then if they're getting outside capital, then a C corp. Is that kind of the progression, or is it different than that?
That's a really common progression. Whether they get big enough before they hit that outside investor, that's a little bit of kind of the decision tree. For our bootstrap companies, we almost always kind of go from an LLC to an S corp. But for outside investing companies that are really looking for a Series A, Series B, it typically goes from that LLC to the C corp.
Gotcha. Okay. And then with LLCs, I'm out of curiosity, is it taxed as an S corp or taxed as a partnership? And what's most common sort of for that early stage company?
Typically, I see them established as taxed as a partnership, but then when the revenue starts getting more, we'll flip that to tax as an S corp.
Got it. But it stays an LLC even when the tax treatment changes? Is that how it works?
Yeah, it's a little bit weird. The tax treatment and the entity structure don't always exactly align. And so it's looking at really how the tax treatment works is the kind of how we refer to it.
Yeah. Okay, great. That's super. And so you had some other strategies for tax savings?
Yeah, so the other one we typically see is looking at that cash versus accrual basis. So whether you're keeping your books on the accrual or cash basis, you can file your taxes on either as well. We don't typically see the books being kept on cash and then filing on accrual, but if you're keeping the books on accrual, you can decide whether you're going to go a cash basis or accrual basis filing. Basically what this means is if your liability section is bigger than your current asset section, it usually makes sense to be an accrual basis filer. In other words, you can just defer that tax payment a little bit longer. And so if you're a company that has good revenue, but it's deferred and spread over a long period of time, and you're charging through auto payments, meaning you don't have a big receivable, it usually makes sense to be an accrual basis filer. But that's one of the things we'll kind of evaluate is to figure out what's the best way to do this to save the taxes.
Got it. So keep your books in accrual, and then when it comes time to tax time, you can afford it either which way, depending on which one saves you more money.
That's it.
Got it. And can you change that every year, or are you locked in for tax purposes? Are you locked in, or you can change for every filing year?
You can't change for every year. You're kind of locked in for a couple of years once you make the change. So you want to look at not just what the current year's doing, but what the next couple of years are planning on doing.
Got it. Okay, that makes sense. Good to know that. And you said I think there was a third one that you were recommending as well to be considered.
Yeah, the third one is the R&D tax credits. This is a credit program. It's a cashback program if you're paying taxes to be able to save money and get credit for the research and development that you do. It's an odd credit. It can be a bit confusing, but it relates to how much money you're spending on development in the United States. If you're offshoring, you don't get the credit for that. So it helps to be kind of strategic on the tax implications of whether you're onshoring or offshoring.
Got it. Great. So I had another question around something I've heard of, and if you know something about that, I want to share, feel free. So I'm just going to as context. So I'll ask the question. So Rusty, one of the things I hear a lot about, but don't really fully understand at the level of detail I think you might, is something around capitalizing R&D. Is that something you deal with sort of in your client work? And if you do, like what is it exactly? If you could explain that to others, that'd be awesome.
Oh, this is a heavy topic, Victor. It takes a couple of branches.
Okay.
So the rules around capitalized research and development cost are different for book purposes and tax purposes. Most smaller companies kind of treat them the same on the tax basis rules. So if you're a larger company and you're looking at GAAP financials that are getting audited, just know that the capitalized rules are a little bit different there than what we're going to talk about here, which are really more for tax purposes. So for tax purposes, what we're looking at here is there's been a rule on the tax books forever that says when you have R&D, you can't take that credit, that expense on your P&L right away. You have to spread that benefit over a period of time. And that's 5 years for onshore and 15 years for offshore. But there was a temporary rule, that temporary rule has been there for 20 years, that said, hey, we want to encourage R&D domestically. So you take that R&D rather than capitalizing it, you can go ahead and expense it right away. But that rule changed. It wasn't a new rule that put on, it was a rule that they kind of took away. So we reverted back to the rules back from the 1970s or so. But basically what that means is when you spend money on R&D, it doesn't go right to your P&L for tax purposes. It gets kind of caught up. So for your books, it's often can be an expense, but for taxes, you have to kind of shift that over. What that really means is if you have a company where you have some revenue, but you're spending that cash flow primarily on R&D, it can create some really funny effects for taxes, where normally you see that you don't have net income. All of a sudden you have taxable net income because all the money you spent on R&D, you can't kind of take credit for in the current year. And so it really threw some companies for a loop here this past year when the rules kind of reverted back to the old ways.
Got it. And is this something that a founder can kind of take advantage on their own, or are you really getting to more of like a bookkeeping assistance or more of like an accounting, CPA, tax return type of assistance? Like which expert is sort of has the relevant expertise for a situation like this?
This is primarily on the tax side. There are some DIY options out there. There's some apps that will kind of walk you through the logic and the process to be able to capture that. But there are specialists in the CPA community that kind of help you walk you through that as well.
Got it. And is the savings like enough to sort of be worth the hassle, or is it like kind of no big deal?
It can be worth the hassle. Again, they're kind of two different concepts, which get super confusing. There's the capitalization of R&D, so that's spreading it over the period. And as a separate item, it's the how can I get that credit back? And so you can do one, but not the other. Like you can't do the credit without doing the deferral, but sometimes you have to do the deferral, but you can't get the credit. So they are kind of two separate calculations to be able to do that. And there is help out there for both, either from the CPA community or there's lots of resources as well. But it's confusing on kind of what issue you're really tackling.
I hear about it forever in board meetings. It's like no one wants to talk about finance unless it's either a pain that needs to be solved or there's money to be made. And then we talk about, honestly, as minimally as possible, but we still it's necessary. So we have to do it. So I've been hearing about all this stuff for forever.
Absolutely. And this particular topic is both. It's both a pain that creates expense, but also a potential benefit, depending on how you navigate it.
So Rusty, as we wrap up here, where can people sort of find more about you, about your company's offerings and services? What's a good place to sort of reach out and contact you?
Yeah, the website's always great at the SaaSbookkeeper.com. We primarily offer the monthly bookkeeping and monthly close services, as well as income tax services. And we help early stage companies so that the SaaS companies between really that 0 and 10 million revenue.
Got it. That's your sweet spot. Perfect. And I'm so curious. I didn't ask earlier, but why SaaS companies? I'm in SaaS, so I love that. But it's very unusual to find a bookkeeping company that's really focused on SaaS. And first of all, like why can't other bookkeeping companies work, or are there some downsides? And then I'm curious from your story, why did you pick SaaS sort of early on to focus on?
Oh, I picked it really early on. Gosh, I've been doing CPA work for 25 years or so. And just a year or two out of school, I happened to luck on to working on a SaaS company. They weren't called SaaS back then, but it was a software company who was trying to do, kind of subscription-based offerings. And honestly, I fell in love because they had great snacks in the break room and bright, colorful colors in the office. And at the time, it was revolutionary for a 20-something-year-old kid. And so I kind of shifted my whole career to working with software companies at that point, working in the big firms and public software companies, kind of all the way to the small ones. And as I progressed, I really just enjoyed the journey. I like the innovation and the founder community and the support within technology. And you just don't find that in other industries.
Cool. Yeah. So one thing I always tell my clients is when you're hiring for their finance team, especially CFO, but certainly sort of you work down that sort of a finance stack, is there's so many little quirks in SaaS, whether it's chart of accounts, sort of tax options and tax savings options, and then conventions and metrics and whatnot, that it really benefits you to have people who know the industry, because there really are quirks. And certainly at the CFO level, which is what I deal with most in terms of like helping companies recruit CFOs and train them and interview them. There are these things that really, the industry expertise really makes a difference. And so I would encourage everyone to go check out the SaaSbookkeeper.com. Rusty, thanks so much for sharing your time and your expertise. I super appreciate it.
Good to see you, Victor.